Here are the top 5 things that I get asked by investors regarding 1031 exchanges. And you can be a very seasoned investor and still be new to a 1031 exchange. I recently had an investor who had done tons of different stuff, developing flips, buy and holds, all the things within a 35-year period and had never done a 1031 exchange. So if you're new to 1031s, don't feel bad about that. You might just be a buy and hold like this guy had been. So understand that a 1031 exchange is for investment real estate. And this is key because the top thing that I hear from investors that they don't understand is that you can sell an apartment building and go buy a piece of land, or you can sell an office building and go buy a vacation rental. Like, you can exchange any type of investment real estate. The key is investment real estate for any other investment real estate, and it work for a 1031 exchange. So it doesn't have to be an apartment building to an apartment building. It just has to be held for investment purposes. So that misunderstanding is the number one thing that I hear. Just be aware that you have lots of flexibility out there in the investment world if you're going to do a 1031 exchange. Then the second thing that is oftentimes misunderstood is that with a 1031 exchange, you're deferring your capital gains, but you're also deferring the depreciation recapture. So as an investor, you have to take depreciation as part of your ongoing investment. And when you sell the property, the depreciation recapture is at a higher percentage than your capital gains most of the time. So the 1031 exchange allows you to defer both the capital gain and the depreciation recapture. But when you exchange your property, the basis that you had for depreciation is going to carry over into the property that you're purchasing as well. So it's not like it automatically goes away. It will get carried over and accounted for on the property that you purchase too. The third thing that I really hear a lot is that there's a misunderstanding about how much you have to sell and buy for. So the general rule of thumb is that if you sell, for instance, you sell a $1 million property, you have to buy at least a $1 million property or more, or else if you don't, what's left is considered boot, which means money that you would take out, and that money you would pay tax on, but you could still defer. So let's say you bought an $800,000 property and sold a $1 million one. That $200,000 you would pay tax on, but the other 800 is going to stay deferred as part of your 1031 exchange. The other key thing to note too is that mortgage balances must also be carried over. So if your $1 million property had a $500,000 mortgage, then when you purchase, you have to also replace the debt with $500,000 or more. And if you don't, then that would be considered likewise a boot in that scenario as well. So you have to have equal or greater purchase price and equal or greater debt in the new property in order for it to basically be completely deferred and there not be considered a boot in that transaction. The fourth question that I oftentimes hear is, can you do seller financing? Now, if you're a seller wanting to do a 1031 exchange, most likely not. I mean, there's some instances where you can do some fancy maneuvering and maybe offer some seller financing to your buyer, but that can get more challenging to do. However, if you're a buyer doing your up leg, meaning you're purchasing in your 1031 exchange, then that seller can offer you seller financing, but it would need to be recorded as a mortgage and not as a sales installment agreement for it to work for your 1031 exchange, because then it would be just like the seller acting like a bank in that transaction and providing the debt for your 1031 exchange. And then the fifth thing that I hear is, what about the escrows and the rents? So you're going to encounter this if you do a 1031 exchange, because the rules governing the exchange say it must be the investment real estate and it can't be outside income. Those prorated rents and security deposits oftentimes need to be exchanged outside of the settlement statement instead of being included in it, just so that there's no potential for a conflict to say that there was outside income being brought in for that 1031 exchange. So it's just good to be aware of that. That's very common with a 1031 exchange, especially with security deposits. Those have to be handled separately between the buyer and the seller instead of being put on your settlement statement directly. So those are the top 5 questions that I hear from investors regarding 1031 exchanges. I hope this video brought you some value. And if so, please like, comment, and share. And if you're looking for investment real estate to buy or sell with it throughout the US, please reach out to us. We're happy to help.